This video covers accounting for depreciation expenses. Companies often buy assets that they use for multiple years. For example, vehicles, buildings, equipment, and so on. These items can be used for several years, some longer than others. These assets are called long-term assets. In accounting, we have a classification called long-term, which is more than 1 year. Sometimes the term non-current also means the same as long-term. The other classification, which we don't talk about here, is called current or short-term, which is 1 year or less. But this section, we're going to talk about long-term assets. Long-term assets do not last forever. They do need to be replaced at some point in the future. The company will use them up and they'll have to replace them. Because they're used up, there is a cost associated with using these long-term assets, and we call that depreciation expense. We assume that land is never going to be used up forever, that has unlimited life, so we do not depreciate land in accounting. Now let's look at depreciation. Most people have heard the term depreciation and assume that depreciation is loss of value. In accounting, depreciation has a different meaning. Depreciation is the cost of an asset allocated over its useful life. So what we do is we take the cost of an asset and figure out what is the cost of using that asset each year. That is depreciation. To calculate depreciation expenses, we need to have 4 things, and these are usually going to be given in your question. First, you need to know the cost of an asset. The cost of an asset is the purchase price of the asset. Second, we need to know the useful life. This is the time period that the company expects to use the asset. The useful life is an estimated amount, and later you'll find that that can change. The third one is salvage value. Sometimes you'll hear the term residual value. They both mean the same thing. Salvage value is the amount the company expects to receive from the sale of the asset at the end of its useful life. So this is basically how much we can sell the asset for once we're done using it. Again, this is also an estimated amount because this occurs in the future. Finally, we need to know the date of purchase. Most of the time, the date of purchase may not be shown in a question. In that case, we assume that it was bought on the first of the year. Most companies don't buy assets on the first of the year. In reality, companies buy assets whenever they need them. And the rule that you need to remember is that the assets are depreciated only for the months the asset is owned by the company. If a company bought an asset in the middle of the year, then only half the year of depreciation will be recorded for the year of purchase. Again, we'll talk about that later, but for now, just know what items you need to calculate depreciation expense. Once you have those items to calculate depreciation expense, we use a formula. This formula is the straight line method. There are several other methods we'll talk about later in this course, but this is the easiest. To calculate depreciation expense, you take the cost of the asset, subtract the salvage value, and then find the product of that. Once you find cost minus salvage value, you divide that entire numerator by the useful life. We'll do a calculation and an example in a minute. Now, that's to calculate depreciation expense. Depreciation expense, as you know, is an expense, therefore it's going to be reported in the income statement. The long-term asset is an asset, and that will be reported in the balance sheet. However, when we report long-term assets in the balance sheet, we're going to report something called the book value. And the book value of the asset is what's reported in the balance sheet. We don't typically call it book value. It's not reported as book value in the balance sheet. Sometimes they may say net asset or just show it as cost minus something called accumulated depreciation. It is very important to remember that book value is what's reported in the balance sheet relating to this long-term asset. Depreciation expense. When we recognize depreciation expense, it is a year-end adjustment. When we're recording depreciation expense increases, and an account called accumulated depreciation also increases. And accumulated depreciation causes the book value to decrease. At this point, I'm just giving you the facts. We are going to do an example that will help you understand these concepts a little better. Keep in mind, when depreciating the asset, we don't touch the cost of the asset. That's never decreased. We only record depreciation expense by increasing depreciation expense and increasing accumulated depreciation. Now let's look at accumulated depreciation. Accumulated depreciation is a new type of account that you haven't heard of before. It's a contra asset account. Remember, cash, equipment, accounts receivable, those are all asset accounts. Well, this is a contra asset account. Contra means opposite, so it's opposite of an asset account. Accumulated depreciation is always tied to the asset account it is depreciating. They cannot exist separately. So if you see a long-term asset, for example, an equipment account, there will always be an accumulated depreciation account tied to that equipment. If the company gets rid of the equipment, the accumulated depreciation account will also be out of there because one cannot exist without the other. The asset and the accumulated depreciation are both reported in the assets section of the balance sheet. So when we're looking at the financial statement impact, when we're reporting it in the form of financial statements, the long-term asset and the accumulated depreciation will both be reported in the assets section. These previous slides contained a lot of information, so be sure to review and go watch it all over again, make your notes, and be comfortable with the theory part. However, before you do that, you may want to watch the next section, which is on the examples. So we'll go to the examples and go back and review the theory part after you've understood the examples. This example says, on January 1, year 1, the company purchased a car for $30,000. The company estimates a salvage value of 0 and an estimated useful life of 5 years. They want you to calculate the depreciation expense each year from year 1 to year 5. They want you to calculate the accumulated depreciation each year from year 1 to year 5, and then calculate the book value each year from year 1 to year 5. Before we go do any of that, let's recall the 4 things you need to calculate depreciation. You need cost. Did they give us cost? Yes, cost is $30,000. You need the salvage value. Did they give us salvage value? Yes, they did. They gave a salvage value of 0. We need an estimated useful life. Did they give us that? Yes, they said it's 5 years. And then they gave us a date, the date of purchase, which is on January 1st, year 1. If you read a question and they don't give you a date, just assume that it was purchased on January 1st. Now let's calculate depreciation expense. To calculate depreciation expense, we're going to use that straight line expense formula. So we said depreciation expense is equal to cost minus salvage value. You take the entire numerator and then divide by estimated useful life. So in this example, what is our cost? Cost is $30,000 minus salvage value, which they told us was 0. And then you take the product of that entire numerator and then divide it by estimated useful life, which they told us was 5 years. So we get 30,000 divided by 5, which is 6,000 per year. One thing to know about the depreciation expense calculated using the straight line formula is that the depreciation expense you calculate is the same each year. So the straight line formula gives you the same depreciation expense each year. So it's 6,000 per year. So in year 1, here let me draw a timeline here. And that's 1, 2, 3, 4, 5, 6. So in year 1, you're going to depreciate 6,000. Year 2, 6,000. 3, 6,000. 4, 6,000. Year 5, 6,000. Year 6, 6,000. And then the asset will be fully depreciated. So let's label the years 1, 2, 3, 4, 5, 6. Now that's the timeline. You can hopefully understand what the depreciation is each year. And now let's answer the questions. Let's first look at year 1. When we record depreciation expense every year, the depreciation expense is going to be 6,000. So for year 1, we're going to report $6,000 as depreciation expense. Now, when we record depreciation expense, it's an adjusting entry. Depreciation expense increases and accumulated depreciation increases. So for year 1, our depreciation expense causes accumulated depreciation to increase by 6,000. If accumulated depreciation had a beginning balance, we would have that, but this is year 1, so no beginning balance. Therefore, the ending balance of accumulated depreciation is $6,000. That's to help you understand when we're recording the depreciation expense as an adjusting entry. That took care of question 1 and question 2. Now, question 3 says calculate the book value. We haven't done each year, we've just done year 1 so far. So let me show you, and I'm going to do the rest of it in Excel because it's easier to do the calculations. We're going to look at year 1. So let me label year 1 and so on. Here I'm going to label year 1. This is going to be year 2. And then let Excel do this for me for the next 3 years. There we've got 5 years. On the top line, I'm going to figure out what is the cost of our item that we bought. It's a car, so that's the cost. Second line, I'm going to show the accumulated depreciation. And then cost minus accumulated depreciation will give me the book value. And let me go ahead and put this as a total here. So that we can calculate the cost of accumulated depreciation and the book value. And then each year, the depreciation expense, I'm going to show you that as well. So we've already got the dollar amounts for year 1. What is our cost? We know that the cost is $30,000. What is accumulated depreciation? Accumulated depreciation in year 1 is $6,000. This is the ending balance and we have it listed here. So I'm going to subtract 6,000 because even though accumulated depreciation increased, to calculate book value, we have to decrease accumulated depreciation. So I'm actually going to put a little notification that says less. And that should help you see why that calculation is subtracted. Now, to calculate book value, we take 30,000 minus 6,000. That gives you 24,000 at the end of year one. 24,000 will be reported in the balance sheet. Depreciation expense will be reported in the income statement, and the amount that will be reported in the income statement will be 6,000. The depreciation expense here is 6,000. So that took care of year one. Now let's look at year two. Let me make this centered so that it fits better. Now let's look at year two, and for year two I'm just going to erase these and we'll start new with year two numbers. Year two's depreciation expense is going to be 6,000. Every year, expenses reset. We don't carry balances from year to year. Again, this is something new that you didn't know about, but expenses, revenue, dividend accounts reset, and every year we just start from scratch for those three types of accounts. So depreciation expense is going to be $6,000 for year two. How did we get 6,000? We know that when we use the straight line method, 6,000 per year. So every year we're going to be depreciating $6,000 for this car. Accumulated depreciation does not reset. It stacks up every year just like the other balance sheet accounts. So we had a beginning balance which is the same as last year's ending balance. We had a 6,000 balance. We added another 6,000 for year two's depreciation. So the ending balance of year two accumulated depreciation is now $12,000. So let's see how this would be reported in year two. In the income statement, the depreciation expense would still be reported as 6,000. However, in the balance sheet, we're going to report the cost of the car at 30,000. We will show the cost less accumulated depreciation of 12,000, again accumulated depreciation subtracted, which means the book value of the asset at the end of year two is 18,000 now. Note how the cost of the asset does not change. It's only the accumulated depreciation account that changes from year to year. As time goes by, you'll see that the accumulated depreciation account balance goes up and up and up, and the book value will keep going down and down and down. Let's do year three. Year three, we know depreciation expense is still going to be 6,000. That does not change. Every year it's the same. Accumulated depreciation does change. We had a beginning balance of 12,000, which is what we ended year two with. Now we have another 6,000 when we record the adjusting entry, and then the ending balance is going to be 18,000. When you're reporting it in the balance sheet, the cost of the car is still shown as 30,000, but accumulated depreciation shows now we've depreciated $18,000 of the car, which means the book value is 12,000. In the income statement, we're still going to show 6,000 as a depreciation expense. Year four, depreciation expense gets wiped out. We still only have 6,000, and then we also have that 6,000 going into accumulated depreciation. Don't forget, now we have a beginning balance of 18,000, which means our ending balance of accumulated depreciation is going to be 24,000 at the end of year four. End of year four, depreciation expense is still only $6,000 per year. Cost is still $30,000. However, accumulated depreciation is now $24,000. I'm showing it as a negative because to calculate book value, accumulated depreciation has the effect of decreasing book value. That gives us a book value of $6,000 at the end of year 4. Final year, year 5. Let's delete everything here. Again, we have another depreciation expense for year 5 for $6,000. That will also be shown in your accumulated depreciation. Don't forget your beginning balance of $24,000, which gives us an ending balance in accumulated depreciation of $30,000. For year 5, the cost of the car is $30,000. Accumulated depreciation is $30,000. Book value is 0. And depreciation expense for year 5 is still $6,000. At the end of year 5, which is our estimated useful life, we have a book value of 0, which is equal to our salvage value. We say that we have fully depreciated this asset. If we keep using the asset in year 6, let's say year 6, the company keeps using this asset and they have not sold it at the end of year 6, they will still report the cost as $30,000. They will report accumulated depreciation as $30,000. Therefore, there is no book value. The book value is 0. There will be no additional depreciation expenses because the asset has been fully depreciated. Until the asset is sold, it will remain in the books with a book value of 0. We're going to be looking at another example, but I'll do that in a different video. What's important for you to remember is that as time goes by, accumulated depreciation increases, book value decreases. Accumulated depreciation has the effect of decreasing book value, and we'll take a look at that when we're looking at the next question. That's it for this video. Be sure to watch the next question as well relating to depreciation expense.